Joining us from Dubai, Mr. Arun Leslie John, Senior Market Strategist and Analyst. Welcome, Sam, and thank you for joining us. So we believe that today's figures were very interesting and they were raising concerns in both markets. We all know that the Emirati markets recently have been, of course, noticing some quarterly earnings and some drops. Do you believe that today's figures have any specificities or are they related to any other topic? You have the floor.
So the current correction in the UAE stock markets, I think what we view it as, it is more of a healthy profit booking rather than driven by any macro or major international concerns. So the UAE stock markets had a very good run, especially the DFM. Selected companies in ADX also had a decent rally. So, what is happening right now in the banking as well as in the real estate sector shares are more of a profit booking. In ADX, the FAB shares correction has dragged down the index. Obviously, the rights issue by the FAB had a bearing on the overall index performance. However, we view the current correction more, temporary rather than the beginning of a sustainable downward trend. ADX as well as DFM technically on the charts are near the 100-day SMAs. Both are very near the 100-day SMAs. Hopefully, we might be able to get a bounce back from those levels.
According to this speculation, to what extent do you believe that the markets are capable to actually pick up and what could be the stimulus supporting the market?
So, in our view, global economy is still staying strong. In spite of the trade tariffs, in spite of the recent rise in geopolitical tensions across Europe, the US economy is expected to grow by about 1.5 to 1.8%. Now, that is expected to have a positive benefit in other parts of the world. A major supporting factor from the macroeconomic perspective could be the rate cuts from the Federal Reserve. This year alone, we are expecting 2 additional rate cuts. In 2026 also, we are expecting the rate cut cycle to continue. Now, in a scenario where the economy has not weakened substantially, we believe these rate cuts could act as a tailwind for the stocks across the world. Recently, we have seen that even the Chinese markets have staged a strong recovery on the back of AI. The Japanese markets are also doing really well. So it's only a matter of time before the UAE markets also bounce back. UAE being a major hub of international trade and finance, I think it will catch up with the rest of the global markets. This correction, and as of now, it's more of a buying opportunity rather than beginning of another weakness or anything like that.
Mr. Arun, KSA is currently wishing to increase the percentage of foreign ownership in the companies, which will add liquidity to Saudi markets. What's the impact for the neighborhood, and to what extent will this actually change the balances and the ways for the international MSCI or FTSE?
It's a great move. The last decade or so, we have seen a lot of reforms in the region, not only from Saudi Arabia, but also in the UAE and in the adjacent GCC markets as well. So, many of these reforms, they have helped increase the transparency. They have helped increase the awareness of the GCC markets across the globe. So, if KSA proceeds with the liberalizing the foreign ownership even further, that will be attracting a lot of interest from high quality investors across the globe. Especially GCC investors or GCC share market tends to offer higher dividends than the global counterparts. Let us not forget that majority of the GCC currencies are also pegged to the US dollar. In a world where the interest rates are falling, the dividends are highly appreciated, I think it's just a matter of time before more and more institutional investors as well as big family offices increase their participation in the GCC markets. So the move is really good. I think it will reflect positively on the other GCC markets. Hopefully, it will be increasing overseas participation also, boosting foreign capital flows to the region.
Thank you very much, Mr. Arun, for joining us. It was a pleasure, sir.